In this video, I want to talk a little bit about the E-mini S&P and some day trading, and actually some longer-term position trading and some dollar cost average trading. And the reason I want to talk about that is because when we day trade, you all know that I'm an advocate of keeping those positions as long as we possibly can. I mean, the whole idea of day trading is to get into a position using a small time frame chart so that we can then reduce our risk versus reward ratio and then go for those longer term trades and try and keep those positions for the longer trend. Now, here we are looking at the mini micro and the mini S&P. I have both of them on here because I want to look at the daily chart. And of course, if we just look at the daily chart of the mini micro, it's not got as much history in there because, well, the mini micros have only been going for about 3 or 3.5 months. So to get a longer term chart, we just come out here to the mini account and we can see a longer term trend. This is the overall longer term trend of the S&P. It's something we see all the time, every day. We're all familiar with it, right? We know that the market's been moving through this wave pattern. It pulled back against this previous trend and it started to rally once again. We're kind of coming into this little wedge or kind of a triangle formation in here, as you see right in here. And generally speaking, these are continuation formations, right? So a trend will fall, it'll rally back up, bounce off the top of this trend, and then fall once again. Whether this market does that or not is just, that's just kind of traditionally what we see happen. If we count these, we come in here, this is 1, 2, we get our 3, 4, and then our 5, and then our drop out the bottom, which is 6. Then the market rallies back up, uses this area of support as resistance, and then oftentimes we'll see a drop again like this. Whether that's going to happen in the stock market or not, there's too many fundamental reasons why this market should not make that type of a big drop and come out into this region. More likely we'll probably get something like we've seen in the past where the market's fallen and start to rally again, fall. And the triangle formation means that we have an area of resistance across the top, an area of support across the bottom. And so this market could break out the top and just continue to rally. This is probably a more likely scenario where we're going to see an A, B, a C, and then this market rally and start to come up and test new highs again. That's what I'm anticipating. I think the market's just, the fundamentals of the markets are just too strong to be calling for this huge drop and coming down and test these new lows like many people are anticipating or calling for. Whether that happens or not, that's neither here nor there, right? We're going to trade the patterns as we see them and as the opportunities come around. And so that's what we want to look at. Now, I want to talk to you about a dollar cost average situation that we're sitting in. We started if we come back over here to the mini micro, we started a day trade yesterday. As you can see, we got into the market on the break of this rally and it started to rally in the market. We're up nice, right? And you can see that this market now, if we just draw our trend line in there, and as we always do, our little cross hatches, we're anticipating a pullback, a downside potential in this market, right? But how far? We're going to follow this thing and we'll see that we probably, if this breaks the blue lights on this 30-minute chart, we'll probably see some kind of a pullback before we see the next rally and a push higher. We're up here testing these previous highs from a couple of days ago, and that's where we're at right now. Now I want to show you a dollar cost average strategy as we come in. We only got in with one contract in here because the market was coming down. This was a pullback, and the thought here was, well, maybe this market's going to come down, pull back, and then drop once again, right? So we didn't take a big risk on this because it looked like it might just be a counter trend, but we didn't want to miss the opportunity if it was a reversal. So we got in with one contract, and we're going to come down here and take a look at it closer on a smaller time frame. So you can see this is where we got in, again, down here on the smaller time frame on this rally, and it's done well for us. Come back down here, we look at it on a 5-minute chart, and you can see the same thing, just a little bit closer, and then the range bar 6 chart, of course, is the full trend. Now, I want to show you dollar cost average trading. Now, the question is this market going to continue higher, or is it going to pull back? If we draw our Fibonacci ruler in here, and we just go from, well, we have to go back a little bit further to follow that low, all the way to the high up in here. A retracement or a pullback to 50% would be back down into this region here. But 61.8 would be down here. And you can see that we need to put a stop in here. Right now, I don't have my stop. I've taken it off because of this video. I want to put the stop in for you. So we're coming in here looking at this thing. We need to place a stop. Well, where would we put a stop at this point? We'd come back out here and look at this market. Again, 30-minute chart. 10-minute chart, where would be a great place to put a stop? Well, you say, well, Lan, why don't we just put the stop at break even? Okay, well, let's do that. We'll come in here and put our stop at break even. So we'll just put it a little bit above break even, cover our commissions and fees, and we're good, right? So there we're risking how much money? How much are we risking? Well, we're risking the distance between where the market's currently trading and where we'd get out if we were wrong, if the market came against us. Well, where would that be? Well, that would be clear back down here to our entry. That's $125. So that's a $125 risk here on the mini micro, which, you say, well, $125, that's not a significant amount. Well, it's a percentage amount that we're talking about. It's our full trade. It's the full trade amount. If this was a mini account instead of a mini micro, that'd be $1,000, right? So we have to think about it from a percentage standpoint as well. And so the next logical place to put our stop might be behind these areas of support, right? So we have an area of support that's just right here. This is area of support 1, and this is area of support 2. And then how aggressive do you want to be? This is area of support 3. So as we come in here and we start looking at this and trying to decide how much risk we're going to take, we want to give the market room to grow, right? Because if this market does come and break out of this wedge formation to the upside, then we don't want to miss out on the opportunity of being there and catching the next maybe possibly big run in the stock market, right? This thing could break out the top and continue to run and continue higher, and we would like to be in there for that. But if it turns and breaks and comes back down, we don't want to lose a whole bunch of money either. So we have this dilemma that we end up in when we're actually in the money, when we're making money and we have a profit. So we have to decide how much risk we're willing to take, how much of that profit we're willing to take to give the market some room to grow and move and shake so that it can continue to higher without stopping us out, but also protecting the positions and maybe taking a profit in a small profit in case the market does fall and go completely against us. The other thing that we need to consider is, what if the market does take off and what if the market does run and we're only in with one contract, and then we feel bad because, oh my gosh, I could have made $1,000, but instead I made $100. So, you have what we call fear and greed. You have fear of loss, fear of losing the money that you've made, but you also have fear of not making money that you could have made. So this is the fear and the greed. So the greed comes in. It's like, oh, I'm starting to get greedy. I want to lock in the profits that I have, and I also want to make more money if the market continues to run. So how do we do this? By reducing our risk and coming in and without limiting our profit potential. So I'm going to do something called dollar cost averaging, and I want to show you something. What we need to do is we need to identify areas of support, okay? And one area of strong support is right here. See that horizontal line of support right there? There's another one right here, of course, where the market pulled back, but it's not as strong. I mean, it's just one pullback, it's one hit, and the market started to rally once again. It created this little double top up in here. We're kind of at a decision point where it's going to go up, break new highs across this area of resistance, right? Or is it going to come back down and break this area, this support area? So right now we've got a crosshatch that's coming in here, and it's showing that market is starting to rally, and it's breaking up, looking like it wants to go up and test these previous highs, higher highs and higher lows. X, 1, 2, 3, 4. We're looking for that next high. Now this one didn't break the high, it just matched it. So the question is it going to be able to break it today here in this afternoon session? Generally, we don't see higher highs like that break in the afternoon session, but there's a possibility that it could. But we certainly have these areas of support down here that we need to take into consideration. And if I think this market might possibly rally, we could take an additional risk without taking too much of a risk. Now, we want to take a risk by adding on to our position as we broke above this blue light, but we want to make sure that we're not taking such a big risk that we're not giving the market room to grow. So this is where dollar cost averaging comes in. So I'm going to delete this stop order, and I'm going to come in here and I'm going to draw just a 50% ruler in here, and I'm going to go from where the market's currently trading to where we have our current market. Now see that? What that does is that puts our dollar cost average. If we went in with a second contract, it would jump this order, which is quantity 1, it would jump it all the way up to the 50% range right there, right to that 29.1450, which is right where we would want our order to be behind this area of support. Because if the market comes down and breaks this area of support right here, we probably just want to get out of the market, right? Because that's where we had our stop anyway. We were going to stop ourselves out. So what we're going to do is if we move our stop up there, we're going to risk that additional profit potential for the possibility of additional money. But we want to have that situation, we want to have it so that our risk is behind this area of support. So watch this. So we're going to come in And we're going to do it, and you'll see this is quantity 1, and we're just going to buy one more. So I'm going to hit buy the market. And notice that when I bought the market, my order jumped to 29.1450. Now, why did it do that? Because that's dollar cost averaging, okay? Dollar cost averaging. So now we have a new order, which is sitting where? Right here behind this area of support where we would have gotten out of the market had we been wrong and the market started to turn against us. So that's a great place to put our stop. And if we put our stop right there, you'll notice that it's still protecting us from any losses. We would have no losses. Now, yes, we would lose the amount of money, the profit that we had made, but we could also break our stops apart. We could come in here and we could say one stop here, and we could put our other stop at this other level of support. So if I come in here and delete this and put another stop in here, watch this. Now I got a stop here, and I can put one there. So now I broke my two stops apart, one behind this area of support, one behind this area of support. I'm still taking no risk. I'm not going to lose any money. Yes, I'll lose unrealized gains, but I'll also have additional profit potential at this point. If the market does continue to rally, I'll be able to make money on 2 contracts instead of just one. I've also got myself protected with areas of support by not jumping in too quickly, letting that market run, let it make a little bit of money, and then having my dollar cost average, just move my dollar cost average up to an area where I can still put my stops behind areas of support along this uptrend. So that's called dollar cost averaging, and that's how you build a large portfolio. You let your market run, and then when it gets to a point where you've got some good areas of support that you might want to move a stop to, you dollar cost average, do the calculation with your ruler, and you'd put that in there. Now we got 2 contracts. If we were to add one, we'd have to break this down into 33, 30, 30, 33, right? So we'd have to come down to somewhere around here is where we would dollar cost average. And that would put us into 3 contracts, bring our stop to right here, which is still fine. We could do that because that's behind this area of support. So we could actually go 3, put our order for 3 contracts behind this area of support and be in the market long with 3 and still be taking no risk other than the loss of unrealized gains. We would not take a hit against our open position or against our little nest egg in there, right? By dollar cost averaging and having your dollar cost average calculated out for you so that it's reaching up to levels of support and having your order still behind support so that your stop can be behind support, and then having the market continue to run, this is how you build a portfolio for the long haul. Now, this is not day trading, although we are down here on a very small time frame chart. We're on the 5-minute chart. We are managing our position on the short-term chart, but we can start to move out to some of these longer-term charts once we start dollar cost averaging up. This is called dollar cost averaging up to a larger chart, taking larger risks as the market moves in our favor and making more money and building a portfolio.